So, what makes a healthy market? To me, a healthy market is a bunch of people who think it's gone too far too fast and it's going to crash any moment. And I think that's what we have going on now, both in the housing market and in the stock market. We have normal inflation, the economy is chugging along just fine. CPI seems to be coming down, which could give opportunity for the Fed to be able to lower rates if they want to. But really, I don't see any need, and I think things are going really well. In fact, I kind of love that everybody's waiting for this big crash. What I don't love is that they don't save and they don't put away for their future, but I guess that's what creates opportunity for other people to continue to invest. And to be fair, as much as I feel bad and I hate seeing it in the comments and I hate seeing those videos where people encourage people not to save, I think it actually helps the rest of us who continue to save and put away. What I'm seeing is a market that's climbing a wall of worry, as they say. It continues to go forward. The news continues to make it look scary. And what I'm hoping for this weekend is that somehow things come together with China. We work it out. Trump says something good, and you see the market skyrocket on Monday. Now, I don't know that's going to happen. And as always, this is not financial advice. Don't listen to me. But that's really my hope. And it seems to be what's going on. Things look real scary. There's going to be a new tariff. We're going to get these guys $1 billion. And then lo and behold, it either gets on pause for a few months and things get all exciting and go straight up, or it gets rectified. The Supreme Court overrules this or says you can't do that. And the news just makes it sound like things are going to die and collapse at any moment. And then when you watch the videos and you look at the comments, like, my God, people are cheering it on. Trump sucks, Biden sucks, they all suck. They're ruining our world. We're having massive inflation. Nothing's affordable. Okay, if that's true, why are the restaurants jam packed? Why, when I go to the casinos, is it tough to get in, or the tables and people are betting more money than I'm used to seeing? The poker games are filled. This is filled. They have this water park in here, and you can't even get in, and you got to wait in line. But oh my God, it's all doing terrible, and the economy is going to crash. Guys, pick your head out of the sand and be realistic about the price to earnings and the growth rates. We had some nice pullback. The stocks are more attractive than where we were, and some things are actually an outright bargain in my mind, which doesn't happen too often. That doesn't mean it can't get worse. But when I look at things like United Healthcare and I look at Whirlpool and Target and Nike that I've talked about a bunch of times, and even like Prudential and T. Rowe Price and some good dividend stocks that are paying some nice yields, these things seem totally reasonably priced. In fact, I hadn't looked at Hershey's in a while, and I look, and it's trading at $160 a share. And when I look at the price to earnings, it seems really reasonable too. And if inflation continues, I hate to break it to you guys, that helps these companies. I couldn't believe when I was at the supermarket the other day and a thing of Hershey's Kisses was $12.99. I thought, oh my God, that's so expensive. But you know what? It sells, and the margins are good, and the companies are profitable. And I don't really see what's going to change that unless we see massive unemployment. What I really think is it's just a bunch of babies in the comment section, and I think that's the reality of the world. It's all these complaints with no ability to do anything to fix things. This is not I did this or I did that, but forgive me, when things were tough, I worked two jobs to make more money. I didn't mind it, and I had the energy. And I'm telling you now, as you get older, you get out of shape, at least I do. Your back starts to hurt, your knees start to hurt. You don't have the energy like you used to when you were a kid to work two jobs and do the things that you did back then. So if you save early on and let that money grow, it gives you such an advantage when you get old and don't have the energy. In fact, I know I talk about the trip that I'm going on, but part of the reason I'm going on the trip is I'm worried if I take another 10 or 20 years to wait to do these things, I'm just not going to be able to. So it's just this push and this drive to do things now, save as much as I could when I was younger, but before you get older and you just don't have the energy like you used to. It's really important, guys. And, just find whatever it is. I don't care if it's stocks, I don't care if it's a housing, and I don't care if you overpay and it's too high right now and there's a big correction. if you stick with it, it's hard for me not to think in 20 years you'll be better served with whatever it is that you pick up than putting your head in the sand, complaining about the government, complaining about your boss, and not saving for the future. And what some people are seeing as a negative is what I see as a positive right now. Those high beta, high risk stocks are really taking off. It's interesting to me to see things like Palantir, Hims, is that right? Hims, Oklo, and all of the others that are high risk, high reward type of companies are the ones that are pushing forward. While you see the Magnificent Seven that might be a little overinvested, taking longer to get moving. What I really think is you're going to see this continue and that you're going to see those Magnificent Seven. I think we're going to have new highs by the end of the year. I think you're going to have Amazon over 240 by the time the year's done. I think you're going to see Google back up to 190, maybe even over 200. It seems extremely oversold in my opinion. But again, just my opinion. I haven't looked at where Apple is, but I'm guessing it'll be 230, 240 by the end of the year. Nvidia's already, I thought I saw it, 140. These companies are going to be okay, and they continue to generate a lot of income. I don't know who the winners are going to be. I don't know what's going to really push things, but I think they continue to make good money. When I go to the restaurants, when I go out, when I see friends, and I drive in the neighborhood, I can't tell you how many houses I see that are redoing their front yard or having construction done. Like things are moving along. I get that the news makes it sound scary. I understand that life is not easy, and I understand that things cost more. I get sticker shock too. I hate going to the supermarket and seeing Hershey's Kisses for $12.99 when I think, aren't those things supposed to cost like $4? Like it throws me off too. But things are still busy. People are still spending. They might change the things that they're buying, which is why we see CPI coming down. And I think, at least here in Las Vegas, rents are managing to slow down a bit, but house prices seem to keep chugging along. I was really shocked to see what one of the neighbors' homes sold for, and it sold really quickly. I couldn't believe what they listed for. I expected that they'd have to lower their price, but they were in contract in like less than 10 days and it sold for almost their asking price. So something is a disconnect. I understand more homes are for sale, but if something decent that's attractive and well designed comes to market, it still moves, which tells me there's still a lot of demand. And I can tell you there's a lot of demand. The buyers are just waiting for this big correction. They're waiting for lower interest rates, but that creates a lot of support. That doesn't mean that the market's just going to crash because when you have all of that demand, even if it's below where the prices are today, that is what's called support. And if that support is down there, the sellers are able to sell even if it's at a slower pace to the people that pay above where that support is. The only thing that's going to change that support is, again, massive unemployment that causes those people not to be able to buy. What I generally see is people come in, they want to buy a house, they get intimidated by the price and the interest rates, and they say, I'm just going to wait 6 months. The market drifts a little bit higher and a little bit higher, and then they get stubborn and they don't put their offers in because they're now not going to pay the higher price that they're looking at 6 months later or a year later. Sometimes they even put an offer in lower than where they should. Maybe they even get in contract, they get cold feet, they cancel, and same thing. They then look back in 6 months and the next house that's similar comes to sit for sale and it's more expensive than the one they canceled on, and now they get really stubborn. That doesn't mean that they're not still there and they don't want to buy. So when you hear all of this information about there's no buyers out there, yes, there are. There are a lot of buyers out there. They just think the market's too high. Well, that doesn't mean they win. That doesn't mean they're right. That doesn't mean the market has to come down to meet where they want to buy it. That just means they think it's too high. I see it in the comments in the real estate guys channels. I assume you guys watch a bunch of other people. Do me a favor, put in the comments, tell me who you guys like to watch on YouTube, because maybe I'll find somebody new than the ones I watch. I watch Michael Bordenero. I watch Joseph Carlson. I love Ryan Williams and Russ from Dapper Dividends. I think those guys are great. I like Dividends with Cheese or whatever he calls himself. That guy's super hilarious, and I like some of the research he does. And then what's the guy? Every Saturday he posts his videos. I really like him, and he has like a $3 million portfolio that he's kind of retired off of when he started making more on dividends than he makes at his jobs, and I think he's got some good content. He doesn't do deep dive analysis or anything, and he doesn't really go into it too much, but he'll show how once his dividends had built up that he was able to leave his jobs and live off of his dividends. Oh, Gen X dividend investor. And I know I'm missing some, but I do watch a lot of these guys, and I find the content really interesting. Some I like, some I dislike, or I don't want to say dislike, disagree with often. And I'm curious who I'm missing. Like, who do you guys watch that you think is pretty good, and who do you watch that you don't like? There's actually one guy who he talks about the yield max funds and he uses a cornerstone a lot, talking about how if I just get 20% yield and I negotiate my margin down to 6 or 7%, how if I buy a bunch of cornerstone, I'm paying off my margin with it. And the reality is, I've watched him a bunch of times and I think he gives terrible advice. I wish I remembered the channel's name. But I'm guessing he's a really good trader and actually doesn't read it. He's the biggest self promoter. Oh my God, buy my ebooks and you'll get my cell phone number and blah, blah, blah. I think he's actually turned a small amount of money into a lot. But I also think the advice he gives is super dangerous. So I sit there listening, pulling my hair out, and I really don't have that much to pull out. And I think, oh my God, what kind of advice are you giving these people? Somebody's going to lose all their money. It's just terrible. And at the same time, he does exceptionally well. But I think there's this lack of understanding that he has a good feel for the markets. It's almost like an idiot savant, whatever you want to call it. And kudos to him, but I wish he'd be a little more careful about how he shares it because markets aren't that simple. Look, when I was a trader back on the floor, there were some huge advantages to the floor. And really, the main advantage, I don't know if I've talked about it before, is knowing who's who. So when you get into the pit and everybody's yelling and screaming and the prices are moving all around, it's very similar to seeing the prices on the stocks, but I was trading currencies. The other thing is, to be fair, that bid offer, like we were generally 2 ticks wide. You don't realize it's just a tiny bit of money, but being able to buy on the bid and sell on the offer is a big advantage for one. The other thing is, I know that Bryce worked for Morgan Stanley. I know that James Kill, filled paper for Goldman Sachs. I know that Mike worked for Smith Barney. I know that this guy works for Chase. And it's not this thing about I know that they work, but they're on direct headsets with the guys in New York. I traded the yen against the dollar. In New York, they're trading the interbank market that's the dollar against the yen. And we have an inverse direction. So when that market goes lower, we go higher. Well, the guys in New York are moving hundreds of millions of dollars, whereas each contract of ours is about $125,000 if the yen's at par. It's actually 12,500,000 yen, but if it's at par, which is 10000, it's about 125 grand. Right now, it's much less because the yen's been so weak, the dollar's been so strong. Anyway, when New York is selling, we go higher. The advantage is when I see Bryce and Mike and Killer and all these guys start either buying or selling, I don't know what's going on in New York, but I know something is going on and they're all seeing the same thing and I just need to jump on board. So if they start to buy, I bid up and pay a little bit more than they will because odds are the selling on the other end is going to continue and they're going to push the markets higher. When you see the prices on the computer, you don't know who's who. You're unable to tell which one's which. You don't see them all moving in conjunction the same ways. It's just numbers on the screen moving up and down. It's a much bigger disadvantage. The other thing is what they say is true, like 95% of the people who are buying and selling, they tend to lose money. Well, companies pay for that order flow from the companies that you're trading through. in order to take the other side of people's trades. So all you see is these numbers. You don't understand who's who, and not you, but me as well. And there are just so many disadvantages to trading on a computer. I wish that weren't true because I love to trade, but I find that to be accurate. The other thing with the floor is like you just get comfortable with the emotion. You can hear the noise. And by being able to hear and feel and smell and everything else, I don't know how to explain the energy on the exchange. That's also a huge advantage that day trading or trading on the computer is just way different. Anyway, I don't know how I bounced from this to the trading on the floor to that, but if you know who I'm talking about, who talks about Cornerstone and the yield max funds, I think his content's really interesting. I can't listen to him so much just because of that self-promoting becomes a little too much. And I also don't love that he's selling the yield max products so much because I don't like them. And what I don't like about them, and it's, in fact, I've seen more videos going into this, like how much money do I need to retire with Misty, or how much money should I retire with the other? Look, these funds take on a lot of risk. People don't understand that. So if you're going into retirement and you have 1% or 2% of your portfolio in them, great. Not financial advice again, because maybe these end up being the best things ever for some people. But what they do is they get synthetically long stocks. What I mean by synthetically long is they use options to have the equivalent position of being long. And I will explain why they do that. So instead of buying a stock, I guess MicroStrategy, since I mentioned Misty, instead of buying 100 shares of MicroStrategies, what they will do is they will buy an at the money call and they will sell an at the money put. By buying an at the money call, it gives them the opportunity, if the stock goes higher, to be able to buy the stock at the price it was at before. So meaning if MicroStrategies is trading 300, I know it is not, and they buy the at the money call for today, and today happens to be Monday, and on Friday stock is trading 320. By buying the call, they have the right to buy it at 300. When they sell the at the money put, same one, they're selling the $300 put. What that does is if the stock goes lower, it commits them to having to buy the shares at $300 a share. So if the stock is at $280 at the end of the week, they have to pay $300 for it. They've collected the premium for selling the put. They paid the money for selling the call. And no matter which direction the stock goes, if it goes higher, they have the option to buy it at 300. And if it goes lower, they've committed to having to buy it at 300. That is why they are synthetically long. They end up being the equivalent of being long 100 shares. Now, why do they do that? They do that because you don't have to put up all the money. You make an agreement with whoever you're clearing through to a certain percentage for the options versus buying the stock outright. So if you bought MicroStrategies for $300 a share, you have to put out $30,000. By buying the call and selling the put, hopefully you've put essentially no money out of pocket. You do them at the same price potentially. And then forgive me, there's a bug or something that, anyway, you forgive the blooper or whatever you want to call it. And then you work a deal with whoever you're clearing your trades through that you have to have a certain amount of your money as margin, essentially, even though it's not margin, for the risks that you're taking on for the trade, which is not going to be the full 30,000. A lot of times it's like 25%, which allows you to do more than one of these for the cash you have in the account. Now, I pray to God they're not really leveraging to the hill and doing it 3 or 4 times and taking on that kind of risk. And then the other thing they do to generate those dividends, they're not really dividends, is they'll sell an out of the money call to collect a premium. So pretend for a moment both the call and the put at the $300 strike is $10 and it washes each other out. And you can sell a $310 call for $4. You can use that $4 to distribute to the clients as what they're calling a dividend, or I don't even think they call it a dividend because they recognize it's not. Now, if the stock goes higher, You max out your trade. Let's say it goes to 320. You get the $10 from the stock going higher. You get the $4 for selling the call. You get the two options that wash themselves out, and there's essentially a profit of $14. If the stock goes lower, same example, let's say it dropped to 280 like we said. You still collect that $4 from the call you sold, but you literally lose the $20 from the stock falling $20. Well, 20 minus 4, you've lost $16 per share. They still distribute that $4, but that's why you have the NAV erosion. This is a very risky strategy. And while it seems really attractive because they're giving out what they say are these huge dividend payments, if you're getting into retirement, there's risk there that people don't recognize they're taking on. They get overly attracted to the dividend yields, and it's possible in 2 or 3 years that somebody could be in big trouble because there could be enough erosion on that underlying that they're really low on funds. And even though you're getting 50% return, you're getting 50% return on 10% of the investment you made. Not saying that's going to happen. Again, maybe you do quite well, but he touts these yield max products that I can't stand, primarily because of the sales pitch, not because I think it's a terrible strategy. You add the sales pitch and the amount they charge to manage these funds. I'd rather somebody taking some time learning about options and doing their own option strategy to make money. It's a little of why I talked about selling the puts. It's a way I like to, but I'll do it as a cash secured. I'm not only going to use 25% of the funds, but I'm pretty conservative and I'm older and I'm not looking to take a huge hit because I need to leverage 4 times or whatever else it is that I need to do to try to get 50% dividends. I just think that's a mistake. Anyway, Todd something or other. Anyway, again, I think he's probably a very good trader. I think he really has made the money he talks about, but I think he takes on some big risk. I also think living your life being margined and justifying it because you get 20% dividends and have negotiated your margin rate down to 7% is still some pretty high risk because with a nice correction in the market, you could find yourself getting margin called and in big trouble. And now I'll do my favorite part, which is the disclaimer. Please do not take this as financial advice. You need to do your own research, and if that's not enough, reach out to a financial advisor for advice. Go over your situation and your goal for your monies, and do not listen to me. I am just some idiot on YouTube sharing what works for me and giving some ideas. I love markets. I've loved this stuff since I was really young, so I like talking about it. The other thing is I do this out of selfishness because I find it helps me to keep true to my positions because when I say it on here, I almost feel obligated to stick with it. Somebody made in the comment sections about how I must be much more patient than them because I'm doing an option, a strategy that's 3 months out and they use the weeklies. Quite honestly, I generally use the weeklies too, but I know my own weaknesses and I also know I'm better off going out 3 months and being more patient and trading less. I recognize that. And it's not that I'm more patient. If I were to guess, I'm less patient. It's one of the things that I'm working on as well. And I'm using that strategy and I'm using YouTube because it's forcing me to stay with that United Healthcare position because I really believe in it. And on a day like today where it starts getting above 300 to show you how impatient I am, I start to think, oh, geez, I knew I should have bought the stock and not just sold the put. But you know what? When I settle down and think it through and remember what I talked about on YouTube, it's a reminder, thanks to you guys, that even if it goes straight higher, I've collected the premium from the sale of the put. And if I miss the opportunity of buying it down here because it just goes straight back up, that's okay. I got good return the way I looked at it in terms of the investment that I had at risk, and I just will have less of the trade on than I really hoped. And at the same time, if there's still more bad news to come out and people continue to beat up United Healthcare, maybe I will have an opportunity to pick it up at 250 and maybe it'll even get down to 200 or 220. Even Regeneron collapsing today, for good reason. I guess one of their drug trials didn't go the way that they hoped. But when I look at their earnings, the company looks like a pretty good company. I don't know a ton about Regeneron, so I don't want to oversell it. I just noticed how much it was down today, and then I saw the PE ratio and thought, that seems like it's a little overdone. Now, I bought a little as a trade thinking it's Friday. People may not want to hold it going into the weekend and they may be panicked, but that's just a trade. I don't want anybody taking any reference. I haven't done enough research or due diligence on it. It really was that I saw that the high was like 12 or $1,300 a share, and it was down 15 or 18% today to below 500. And I thought, boy, that's a pretty big move. That doesn't mean it can't keep going. And if I haven't done the research on it, I'm not comfortable putting on a real big position, but I bought a little bit for fun. With United Healthcare, I like their earnings. I like their growth rate. I like that they make something like $12 billion a year and that they're a huge part of our health system, which makes me think similar to Boeing. They're almost too big to fail. And whether it's 3 months down the road, 6 months, or a year, either things will just disappear or they'll get a fine and a slap on the wrist and be able to continue to grow. And the bad news will subside and it'll free up the company to be able to drift higher. I have to think in my mind, if I wait 5 or 10 years, that right now it is on sale. And that's kind of what I'm talking about in terms of beating the market. You have to have that long term time horizon and wait for bad news and understand and analyze the bad news in your own mind. Try to time it the best you can to when it's washed out, which is why I think I might be early on United Healthcare because this news is still kind of fresh. And I still remember how long it drug along on Boeing before it finally reversed. And also recognize that it could be Intel or it could be Sears, and maybe it goes out of business. But if I can have 20 versions of United Healthcare, I think I end up a pretty big winner. And I think I outperform the market pretty well. If you're not comfortable with that stuff, my God, there are things like VOO or QQQM that I think are the greatest things that they've invented ever since sliced bread. Although you can eat sliced bread and you can't really eat the paper that the stock. Anyway, the ETFs, they charge such a small commission. It's totally transformed what mutual funds are. Mutual funds are a waste of time. But if you're disciplined or you don't even watch and you put the like I could put everything in VOO, not need a financial advisor, not financial advice. I suggest you reach out to one. And I've just bought the S&P 500. So if my goal is just to perform what the market's done, I've done it with one ticker in my account. I'd be totally comfortable with that. In fact, I manage an account for a charity organization that I started to suggest that, and then other than it freaking out the people who were on the board, so I spread out into three. It's got VOO, QQQM, and an international one that I picked, um, along with my brother. And anyway, and that's it because I figure that covers the whole spectrum. And then I've outlined an exact percentage of the portfolio that should be in each one, as well as some money in the CDs. So that my attitude is when I retire, I'm off I'm no longer the treasurer and helping them with the planning on their finances. That anybody, even if they don't have a background in finance, simply has to put 25% in this one, 40% in that one. Like it would be plug and play once a year, readjust and move on and be invested in the market and recognize that you don't have to pick stocks. You don't have to be a guru. This is a great way to be invested in the overall market with really minimal fees. I think I love the ETFs, even though I don't invest in them. But that's just because of my ego, and I like playing the game, and I like to see if I can try to outperform, which some years I do, some years I don't. I probably perform right along with the market. In fact, I probably do a little less than what the market does, but that's partially because I'm conservative and a little risk averse, and I have some companies in there that I know are going to underperform. But when the markets have corrections, they tend to do a little bit better. Otherwise, I would probably push harder in the Magnificent Seven, even though I'm highly weighted into those things. I mean, Meta is by far my largest position, and Amazon and Google are pretty close, along with Chevron, and even Starbucks is up there. And that's pretty heavily weighted to the top 5 or 6 stocks in my set it and forget it account. Um, Not that you guys asked. Anyway, do me a favor if you haven't already. Hit that subscribe button, smash the like button. I did it right. Make some comments in the comment section. Like I said before, let me know who else you listen to, partially because I'll go and I'll check them out, and I'm curious as well. Also, that thing keeps on going, whoa, whoa, whoa. It's very weird. Also, do me a favor if you want, tell me what you bought, what you didn't buy, what you sold, what you think about the markets. Somebody was even asking me about restaurants here in town. I love to eat, so feel free to ask me about whatever you like about Vegas too. I'll do my best to answer. Have a great weekend. I'm going to try to talk tomorrow, but I'm planning for the trip, so we'll see how it all goes. Thanks again.